You're back on the street and we're going to talk markets right now with Dryden Pence, CIO of Pence Wealth Management. Dryden, thank you so much for being here. Just firstly, I wanted to ask you, because I was looking through your notes, it seems, you got a relatively bullish kind of a tilt towards expectations moving forward, but I've got to ask you, because one of the things that stuck out to me was that the earnings recession is over. And, we've seen it playing out in terms of, the EPS beats and everything else. But is the earnings recession being over more important than the beginning of a revenue recession that we are starting to see? Because you can only really cut costs once and only really try and, mitigate your margin impact once for the most part when it comes to these things. So is it a worry at all?
No, I actually think that it's more important that the earnings recession is over, and I think that earnings are going to continue to beat, because I think one thing that's happened in the United States is that we went through a long period of time where CFOs could not really understand their cost of capital. We had rapidly rising interest rates, and people could not really compute what their margins were going to be. So now they spend a lot of time kind of downplaying the expectations. Now that they kind of know that we've topped out on this interest rate hiking cycle, I think that CFOs are going to be much, much better going forward in how they can calculate their margins. So the earnings recession being over also gives a much better information circumstance for how we calculate margins and going forward. So I think that we're excited about that, because I think you're going to see a continuous series of quarters of quarterly beats. We had 80% of the companies beat the S&P 500. The last 2 quarters it's been the same thing, and I think you're going to see 4-quarter beats, first quarter beat, and probably second quarter beat going forward.
Really quickly though, because you did mention the Fed just then, and I suppose the clarity that in terms of expectations, but do you think that, are you aligned with I believe the Fed, they're going to keep it higher for longer, so we're going to have a static kind of rate setting, or do you think the market's right and we're going to see at least 100 bips of rate cuts coming through next year?
I think we think the market's kind of got it wrong. I think we're going to be an elongated period of time where it's going to be a higher for longer. And part of this is because the underlying strength of the U.S. economy is still there. You've got more people working than ever before, making more money than ever before, when labor productivity higher than it's ever been. So we think that this idea that you're going to see 100 basis points of rate cuts is probably a little too optimistic, and I think we're going to be in a higher for longer. You're going to be the back half of the year before you maybe see one, and so I think that that's the regime that we're going to fall into, and I think that that's really kind of based on the strength of the U.S. economy. We think the fundamentals are still pretty good.
Then I've got to ask you on that front, because I suppose this would play through to every equity decision that you make. Then if that's correct and we don't have those cuts priced in, that's obviously impacting what we're seeing in terms of the yield settings, if we're talking about, duration particularly, and the 10-year, because everyone uses it for their risk-free calculations. If we don't get the cuts, I would imagine that, the yields are going to kick higher, and then on top of that, you do have this derisory kind of fiscal position. So are you staying away? Because, everyone tries to say, oh, I'm going to buy up all those underloved 493 because, the rates are going to come down and everyone's going to pile back into these once they realise the same thing. So you'd be sticking to the top end of town?
Well, we've been well positioned in the Magnificent Seven, if you will, but I think that we do think that dividend payers over time are going to be doing better, but you want to position early in them. So they've been kind of beat down, and now we're moving forward in that circumstance. We do see rate cuts, but we see them small and to the back end of the year. So positioning now for companies that are dividend payers that have good, strong fundamentals going into an economy that we don't see rolling over. I mean, the death of the consumer has been greatly exaggerated, and we think that people are going to be in pretty good shape. And so we're in a position for companies to see expanding margins. You can see the idea, we've got 11% profit growth projected for next year. That and the idea that you're going to have 4 rate cuts are completely inconsistent. So we think that we're primarily going to focus on companies that are going to grow earnings into next year. And we do think, the 493, if you will, there's a lot of good opportunities in those companies because they are, again, getting into a situation where they can see margin expansion and earnings surprises because they've really kind of been overly cut down in their estimates.
Can I just ask you, because you said that you're, relatively bullish and hopeful about the consumer, those weren't your precise words, and you like Amazon as well, but apart from Amazon and apart from having an upside thesis on Amazon, what other, and not Walmart, but what other retailer would you be looking at then, or other retailers would you be looking at? Because you can kind of sort of make the case that Amazon's been eating everyone's lunch. All the comp sales weakness that everyone else has seen has been because, you know, they're not driving and spending on gas, and they're just having Amazon come and deliver their stuff for free.
Well, I mean, part of the issue on Amazon is very much that they have a strong online presence. And I mean, of course, you mentioned Walmart, but Walmart's number 2 behind Amazon. So we see this, we're getting to this moment where if people are beginning to shop a little more, and they're going to price select a little bit more, and they're going to be, you know, not necessarily price takers, right? I mean, they're going to be in a situation where they're shopping more and more. Online has less inflation than in store. And we're going to continue to see that most of the projections are that online during the Christmas season is going to do well. So anybody associated with that is probably going to be in a better position. So we do like Amazon. We would like Walmart. We would probably take a look at companies involved in that, also Shopify. But I think that most importantly is recognizing that the consumer online is going to continue to grow through this process, because it's cheaper to bargain hunt online, and that's what people are going to do.
Dryden, we've got enough time for an elevator pitch here. Apple, it's consistently seen revenues dropping down in terms of growth, but they're basically at all-time highs right now, or thereabouts. Why buy them now?
The bottom line is people really underestimate the tremendous strength of Apple. If you just take a look of how the company is transforming over time, you see the services sector has doubled in size. I mean, 14 years ago, it didn't even exist. And now the services part of Apple is as big as Johnson & Johnson. If you just took services inside of Apple, it'd be I guess probably, you know, one of the 45th largest companies in the S&P. So people underestimate the size and scale and shape of Apple, and the fact that it's really beginning to expand into services and have more recurring revenues that allows it to have a kind of a different multiple profile. It's Dryden, a transformational.
Absolute pleasure. Thank you so much for your time. We're out of time now. That was Dryden Pence of Pence Wealth Management. Coming up.